Hello, Jim here. Selling options is a great way to make some extra income on a monthly basis. I'm making over 8,000 every month, and the majority of my trades are the vertical put credit spread. I really like it. It works out really well for me. Today, I'm going to share with you a little bit more details about it. I've had members asking questions as well as subscribers, so I wanted to go into a bit more detail. So I'll talk about kind of the ins and outs, why I like it so much. And then at the end of the video, I'll go through an actual trade or what an actual trade would look like, probably on AMD or a similar stock, just so you can get a feel. And I'll go back over some of the key points. So stay tuned. I think it's going to be well worth your while. Okay, let's go ahead and jump right in. A quick introduction related to calls and puts, especially when you're selling calls and puts. So if you're selling a call, say you own 100 shares of a particular stock, and in this example, we'll use Coca-Cola, and say you currently own them and Coke is priced at $70. Well, maybe you're willing to sell those shares at $80, and maybe you're willing to do that for a month so you can sell a covered call at $80. That would be the strike price for a duration of 30 days, and someone will pay you some nice premium when you get that trade filled, meaning it gets accepted by the buyer. Then you get that cash right away. That premium goes right into your account right at that moment. A put is a similar situation. If you want to own some shares in a particular company and you're willing to pay a certain amount, you could say, and let's again use an example of, say, Coca-Cola at $70, you want to own it at $65. You could sell a $65 put, meaning the strike is $65. You're willing to pick up those shares at $65, and maybe you are willing to take that risk or that opportunity for 30 days. So the duration is 30 days. So someone would pay you for the opportunity to sell you those shares at $65 over the next month or 30 days. And again, the premium goes right into your account. So I prefer to sell calls and puts. I find that I've been able to make pretty good money by selling. Buying is a little bit more difficult. I've tried to buy puts for protection at time, and it seems more speculative. So I do encourage people, look at more on the selling side. I think you'll be more successful and more profitable. So next, let's actually jump into the bull spread and talk a little bit about it and why I like it so much. Okay, bull put spreads, they're typically bullish to neutral. So you don't necessarily want the stock to, drop big time. You want it to stay where it is or potentially go up. So what do? The strategy is you sell a put option at a specific strike price. Again, let's use an example, Coca-Cola. You want to own it at 65, so you sell a put at 65. That's called the short put. Then you buy an option, a put option at a lower strike. So you're selling at 65, but you want downward protection. You don't know what's going to go on in the market, and you don't know what's going to go on with Coca-Cola. So you buy a $60 put. And then this kind of sets it as a hedge or a protection, mainly because if Coca-Cola goes below 60, you can put those shares to someone else. So if you're set up with spreads at most of the brokers, they'll give you credit with understanding that you're hedged below 60. So your required capital is just that amount of the spread itself minus whatever premium you might pick up. So again, here's an example. A stock is trading at 100. We'll use a 30 to 60 day expiration with a short put delta of approximately 15. So during these times, especially with September being kind of a bad month, I like to do a 15 delta, and it's just 15 delta on the short. So I will look at that short strike and see if it's a 15 delta, whichever expiration that I might be using. So you sell a $100 put for a premium of $2.50. And then you go $10 out and you buy a $90 put for a premium of $1.50. And a lot of times, it's just a pretty good example. At times, though, I've been able to get closer to 150. So you might pick up 250, and then you might pay $1. And in some instances, it might be next to nothing. If it's really, really cheap, I always tell my members to go ahead and buy those long puts as long as you're set up for spreads. So the net credit in this example would be $100. And that's what I look at for most of my contracts. I want to make $100 for each contract, at least $100. Now, if I'm rolling, I'll accept a little bit less and I might take a little bit more risk with rolling, but that's a whole completely different subject. So the key metrics, maximum profit, the net credit received. So you earned 100 in this example. This is achieved if the stock price is at or above the short put strike price at expiration. So if it never gets past that short or ends up between the short and the long, then you just keep the premium. And that probably happens on 50% of my trades, maybe even more than that. In a lot of cases, you can keep track of what it would cost to close the trade. So I'll tell people, well, look to close it from 60 to 80% or maybe above 60%. So if you made $100, but you could close it for say $20, $25, then it may be worth it. Something to kind of keep in mind. So maximum loss. So what's the most you could lose? In this case, it would be the 100 minus 90, which is $1 minus, which is $900. Or actually it's $10 minus $100 you brought in initially. So it's the required capital is 900. Again, it's the $1,000 you spend on the spread minus your premium, and that's the most you could lose. So if the stock kept falling and falling and falling, and who knows, maybe you're on a vacation in Italy or something, and you can't deal with the trade, your max loss would be $900. In some cases, I rarely have ever had max losses. I usually will manage the trade or I'll close it early, like I was talking about a minute ago. But if I manage it, I might look at closing it and opening another position. And if I open up a new position, I just try to bring in enough premium to potentially improve the position. So if I can lower the strike, that would be good. So there's a lot of different things you can do. I have done, where I've converted the vertical put credit spread into a cash secured put. So I would buy back the short, I would sell the long, and then I would just sell a short and not buy another long. And that would allow me to take the short much lower. So in the example that we've used in the past, or the example we used here, you might be able to take, instead of going to 90, if you didn't do that, maybe you could go to 88. So you did an 88-78 spread versus, a 90-80. But by converting it into a cash secured put, you could potentially go down to 85 or even 80 and bring that short down pretty majorly. Now, if you hadn't bought the long put originally, then you would not be able to do that. And that's another key point, either on the call side or the put side. It's a lot more difficult to add that long hedge down the road. So it's better to do it on the initial trade. It usually doesn't pay off to add it, after the trade has already kind of been live or open for quite a while. And between the break-even point or the break-even point is the short put strike price minus the net credit. So it would be, right around $99. So, and I don't really worry as much about break evens, so how do I manipulate or manage the risk? It's the strike price selection. I typically want to own all the stocks that I'm trading. The exception is maybe IWM or some of the ETFs. So I'm picking a strike that I think that the company, that's a good price for the company. It's not overvalued. The PE is pretty close to the sector. It's not shot through the roof, like Palantir and some of the companies that have 200-300 PEs. I won't trade in. I also don't trade in companies that don't make money. But to me, it's more selecting the right company and then deciding on what the strike price, and then also using that 15 delta to come up with the strike price. And I usually go out typically 30 to 60 days, probably on average 45 days, but I do like to go a little further out. Sometimes I'll even go 90 days out. And then the spread width, I will start with the $10 spread, But I'll sometimes look at the 9, 8, and 7. And in some cases, maybe the $7 spread is a better way to go than the $10 spread. I do have a lot of members who, they like $5 spreads. I like $10 spreads. There's others that will do more contracts and do $2 spreads. So it kind of depends on what works for you. Once you find something that works, I like to make small tweaks to it and try to improve it. I don't like to do radical changes. I'm also very risk averse, so I won't deal with a lot of the riskier type trades, which usually means fewer contracts. Determining what your maximum loss is. And I don't, again, since I want to own the stock, I don't typically get out of the position at a certain loss, again, because in most cases, and even in April, when I had so much assigned, I ended up picking up a lot of great companies at great prices. So, but there are a lot of traders that will look and they'll say, well, I'm willing to take this amount of loss. So you can set up a stop loss related to that. And then the break even point, maybe, and I look at this more at closing it for a profit. So some people may close every position if it gets 50% profitable. I've heard people say 25% profitable. I like to do typically 80 to 90. I've had some over 90. Recently, like I had an IWM Iron Condor, which is similar. It's like two spreads. It's a call spread and a put spread all on the same position, all vertical. And I closed that early. I closed that more like 65 or 70% profitable. And then also the number of contracts. I tell people I started with 1, then I went to 2. On occasion, I'll do 3. If it's a real inexpensive stock like a Mora or a SoFi, I might do 4 contracts. But I have other people who would do 5 or 10. And that does up the risk, again, because if you do 10 contracts, if you do end up getting assigned, you do need enough money in your account to cover that. So just something else to keep in mind. And then duration. So the farther you go out and you use a 15 delta, the lower the price. So, if you're doing a weekly on, $100 stock, the strike might be 95. You do a monthly, it might be 90. You go out 2 months, it might be 80, 85, something along those lines, the strike price. So the longer the duration, plus you can make more premium. There's an argument, though, if you do 4 weeklies compared to a monthly, you'll do better with those 4 weeklies. I prefer to do monthlies. I try to do 1 or 2 trades a day, and then I'm done. And then finally, risk management and best practices, position sizing. Only risk a small percentage of your portfolio. So I like to trade on a lot of different stocks. Liquidity, choose spreads that are highly liquid stocks. So, and I talked about that in my last video. If you're going with the big boys, you'll be fine. The liquidity is really good. It's when you kind of try some stocks that are a little bit less well known, the liquidity might not be as well. It's always good to look at the volume and the open interest for a stock you're considering trading in. And then rolling spreads, learn how to roll a spread, adjusting the expiration date or strike prices. So, and again, remember, rolling is just closing your current position and opening a new one. So, you can look at it rolling. You can roll out to the next month and potentially try to lower the strike, or just, if the stock is just at risk right now, maybe slightly in the money, and maybe you just need more time, roll it out to the next month and keep the same strikes. I'll probably do that 50, 60% of the time. If you want to lower it because the stock you fear is going to drop quite a bit more, you can also try to lower it. You can widen the spread. You could even add more contracts. So you can roll a two contract position into a 3 contract position. I have an area in my membership, in my Discord, where people who are dealing with rolling or at-risk trades can actually share the trade, and we talk about it as a group to try to help them. And then trading psychology, it's a lot of times people panic. You need to be disciplined. It's a lot of times the stock will recover. Nothing's a straight line. It's, I have a lot of positions to go in the money, out of the money, in the money, out of the money, and so on and so on. So, and then set up a plan, set up goals, stick to that plan and goals. Now, putting it all together, trading and execution, I always encourage people to do paper trading. If you're new to spreads or iron condors or any, even trading, certain types of ETFs like these hedged ETFs, it's always a good idea to paper trade. Thinkorswim has paper trading. Interactive Brokers has paper trading. Even if you have to set up a free account, it's a good idea. Brokerage account, understanding the options approval levels required for spreads. And it's, as you become more experienced, the brokers don't want people to blow up their accounts, don't want people to lose tons of money and put their portfolios at risk. So if you show some consistency, you're not doing crazy things. Once you get approval with one, then it's a lot easier to get approval with others. And then the order ticket. So I like to use the order ticket a lot of times when I'm looking at a position, and that's what we're going to do next. We'll actually look at the trading page at Schwab, and we'll play around with the trade I did last week. I'll talk about that next. But I really like using the trading pages and trying different strikes and different expirations to get a feel for, what I'm willing to accept premium wise and risk wise. So stay tuned. Let's jump into the next part, and we'll just do kind of a quick I think it's going to be on AMD, kind of a quick mock trade. It'll be live, but I just won't push it through, mainly because I already have an AMD trade. So we'll be looking at the similar trade. So stay tuned. Let's jump into that next. Okay, here's a trade I did last week. This is what I share with my memberships. I post this in Patreon typically right after I do the trade. Then I also post it in Discord. So if you have notifications set up, you'll get notified right when I do a trade. And I usually put some emphasis on why I like the stock, why I'm making the trade. And that's what I do here. I had an annualized return of 133. I made 273 in premium. It was a 135, 125. So I sold a put. I'm willing to own them at 135, but I hedged with a 125. I did expiration of 1017. Like right now, I'm doing most of my expirations for 1017. I haven't gone to November yet. And I did 2 contracts. Now, this was a very profitable trade. I could have done 3 or 4, but I'm not trying to get rich. I just want to make some money and do well enough. Here, I decided to sell another spread. AMD got hit hard because I believe Broadcom had a good report of a big deal that they made, and there were a lot of fear, I guess, in Wall Street that would hurt AMD. I think there's plenty of AI chips and the ability to grow pretty rapidly for almost all the companies. I think AMD is going to be a $200 company late this year, early next, or maybe sometime next year. So I do own 200 shares. I want to own 200 more. I do not expect. So here I say I now have 3 positions open on AMD. So it's a little bit high for me. One of them is pretty way out of the money. I plan to close all but one, hopefully early, and end up owning 200 more shares, and how it could go the other way and give up all the gains. So it could go the other way. I mean, sometimes it gets, negative momentum, and I believe it may be down now. We'll see in a minute. But I don't expect that to happen. And if it does, it's only going to happen probably for a short period of time. And then I typically will show details about the trade, how much premium what I paid. So I paid 235, so almost 120 per contract for buying the long put. And then and I share these. I usually do 2 or 3 trades a day, and usually I'm trying to make 2,000 each week, so I'm trying to make 200 on each trade and something along those lines. Now, if we go over here and we look at the trade ticket, so I have AMD. I want to do a vertical put, so they make it really easy. And I can look at the same trade. I can go out to 1017. So I'm saying sell open 1 contract in AMD expiring on 1017. I'm going to look at, I believe over here, let's move this out of the way. I had 135, 125. So we'll look at the same trade. We'll go down to 135, 239, and then, so the bid is 239, the ask is 242. So it's pretty close. It's within $4 or $5, which is also what you like to see. And you see that with the big boys. On some companies, you might see huge differences between the bid and ask. And then for hedging, I'm going to buy to open one contract, AMD, and I'm going to go down here to 125. So I'm looking at 134, very similar trade to what I had last week. So I could make anywhere from 133 to 139. I'm bringing in right around 242 to 245, and I'm paying $1.06 to $1.08. Now, some people may say, well, I want to just bring in the full premium. But if I didn't have this long put and I would have to have, it wouldn't be, I wouldn't get this credit for this put of course, if I didn't have it, but I would need enough, it would look at my cash and it would say for this one contract, you need 13,500 minus whatever premium you bring in. Now, if I have this 125, I only need the difference between 135 and 125, which is 10, and you multiply that by 100. So it's 1,000 minus, I'd bring in 136 in premium, and that's what that's showing here. So it'd be like 863, I guess, or 864 is how much cash I would need on hand, or how much required capital. So it does make a big difference, and you get credit for that long put when you're at that spread level. So I believe in Schwab it's level 2. Now, what I would typically do here is I might play around. Now, with it being $5 differences, like I could look at a $5 spread, so I could go to 130 and see it drop quite a bit, but it's still not bad for a $5 spread. So 500 minus 81, I'm putting at risk $300 to $400 to make 82. A lot of times, though, you'll see these are, not $5 differences. They may be $1 differences, and you might find, that if you thin the spread out, again, it might be a better deal. It might be you might make more money on a thinner spread, which is unusual. But I would go back to 135, 125. Then recently, I've been going with the really close to the ask. I might do the ask or $1 or $2 less than the ask. So I might look at doing 138. It's nice because these are so close. This is 138, 135, 133. So I know just by looking at these numbers, it would probably be able to go through without much of an effort. And then I typically do 2 contracts, so I would add another contract, so I'd make 276. Now, I might say this is a wonderful trade. I don't think there's any way AMD is going to go down that much. I would do 3 trades possibly and bring in over $400. If I didn't have so many other, I believe I have another vertical put credit spread and I have a cash secured put on AMD, so I wouldn't do that. But if you think it's an excellent trade and that it's going to work out well, you could go with 3. If you want just to do a cash secured put, then you could remove this, and you can see that's $720 for 3 contracts. And if you have a huge account, then it's not a concern. It's something you could do. So, and this is where I really like playing around with this. I can also look at the short. I can see the Greeks here, and I can see it's around a 18, just shy of a 19 delta. So if I went down to 130, I could see, well, what is the 130? The 130 is a 13 delta. You can see it right here. So I typically like going above. I won't go to like an 11 or 12 delta, but I would go back up to 135. I can see the duration, it's for 39 days. I can see the volume. I can see the open interest. I like how they provide even the IV, you can see here. So they do a really nice job with this page, and they've added more. I noticed even recently they added more. So that's just kind of an overview. That's one thing you could do. So let me know what you think. Is this something you're looking at doing? Are you doing vertical put credit spreads? Do you like them? Do you not like them? If you don't like them, why? I'd love to hear your comments to see why you don't like them and why they don't work well for you. And as always, thanks for taking the time to watch the video, and hope you have a wonderful day.